Hello, everyone, and welcome to today's deep dive into mastering your finances. I'm thrilled you're here because today we're going to explore a range of money management strategies that can truly transform your financial future. Whether you're just starting out or looking to fine-tune your approach to budgeting, saving, and growing your wealth, this video is packed with actionable insights that you can start using right away. Let's begin by talking about the importance of understanding where your money is coming from and where it's going. Every financial journey starts with a clear picture of your income and expenses. It's crucial to track your spending diligently. Write down every purchase for a month or use one of the many budgeting apps available. This isn't about restricting yourself, but about understanding your habits so you can make intentional choices. When you know exactly what portions of your income are committed to necessities, discretionary spending, and savings, you gain the power to reallocate funds toward your future goals. Once you have a handle on your cash flow, the next step is to create a realistic budget. A budget isn't a magic rulebook that limits your freedom. It's a tool that empowers you to direct your money toward what matters most. One popular method is the 50-30-20 rule, allocating 50% of your income to needs, 30% to wants, and 20% to savings and debt repayment. However, every situation is unique. Maybe you have specific short-term goals like paying off a student loan or saving for a down payment, and you might need to adjust these percentages. The key is to be honest with yourself about your priorities and to review and tweak your budget as your circumstances change. Speaking of savings, building an emergency fund is one of the most critical steps you can take. Life is full of surprises, unexpected medical bills, car repairs, or even a sudden job loss, and having a financial cushion can keep you afloat during turbulent times. Aim to save at least 3 to 6 months worth of living expenses in an easily accessible account. This fund isn't meant for everyday spending, it's your safety net, allowing you to handle emergencies without resorting to high-interest debt. As you work toward building that fund, automate your savings if possible, set up a direct deposit into a savings account each payday, so you're consistently making progress without even thinking about it. Now let's shift gears and talk about debt, a topic that can feel overwhelming, but is absolutely manageable with the right approach. It's important to distinguish between good debt and bad debt. Good debt might include a mortgage or student loans if they're helping you build long-term wealth or advance your career, while bad debt usually refers to high-interest credit card balances that can spiral out of control. If you're carrying significant debt, consider strategies like the avalanche or snowball method to pay it down. The avalanche method focuses on paying off the debt with the highest interest rate first, while the snowball method targets the smallest balances to give you quick wins and boost your motivation. Whichever method you choose, the goal is to reduce your overall debt burden so you can redirect those funds toward investing in your future. Investing is where many people find the real magic of personal finance. While saving money in a bank account is essential for short-term needs, the true power of your money comes from making it work for you. There are a variety of investment options available, ranging from low-cost index funds to individual stocks, bonds, and even alternative investments. One key principle is to start early and be consistent thanks to the power of compounding. Even small, regular investments can grow significantly over time. For example, investing a modest amount each month in a diversified portfolio can turn into a substantial nest egg over several decades. The most important part is to educate yourself about the basics of investing and to develop a strategy that aligns with your risk tolerance and long-term goals. Retirement planning is another vital component of financial health. It's never too early to start planning for retirement, and if you're already on this path, consider ways to maximize your contributions. Take full advantage of any employer-sponsored retirement plans like a 401k or 403b, especially if your employer offers matching contributions. If you're self-employed or your employer doesn't provide a retirement plan, look into opening an IRA or Roth IRA. Each type of account has its own tax advantages, so it's worth spending some time understanding which one is best suited to your financial situation. The goal here isn't just to retire, but to retire comfortably with the freedom to pursue your passions without financial worry. Another crucial aspect of financial success is managing your credit. Your credit score can have a significant impact on your ability to secure favorable loan terms for a home, car, or even your business ventures. Simple steps like paying your bills on time, keeping your credit utilization low, and monitoring your credit report regularly can help maintain a healthy score. If you've encountered credit issues in the past, don't be discouraged. Improving your credit takes time, but it's entirely possible with consistent positive financial behaviors. Beyond the mechanics of budgeting, saving, and investing, it's essential to cultivate a mindset of financial discipline and growth. Many people think that financial success is about making a lot of money, but it's really about managing what you have wisely. It involves developing habits like mindful spending, setting clear financial goals, and learning to delay gratification. Instead of indulging in every impulse purchase, try to focus on the bigger picture and how each decision brings you closer to your financial objectives. Reflect on your values and ask yourself whether each expense aligns with your long-term vision for your life. This mental shift can be transformative, turning financial management from a chore into a pathway for personal empowerment. One often overlooked aspect of finances is the importance of continuous learning. The world of finance is always evolving, new investment vehicles emerge, economic conditions shift, and innovative financial technologies are developed. Stay curious and invest in your financial education. Read books, listen to podcasts, and follow reputable financial news sources. The more you know, the better equipped you'll be to make informed decisions that help you navigate both opportunities and challenges. Remember, financial literacy isn't something you master overnight. It's a lifelong journey, and every bit of knowledge you gain builds your confidence and capability. Let's talk a little about diversification, a term you might have heard thrown around a lot. Diversification is the practice of spreading your investments across different asset classes to reduce risk. Think of it as not putting all your eggs in one basket. By investing in a mix of stocks, bonds, real estate, and even commodities, you can mitigate the impact of a downturn in any one area. While diversification won't guarantee against loss, it can help smooth out the bumps along the road to financial growth. Tailor your investment mix to your personal risk tolerance and time horizon, and don't be afraid to reassess and rebalance your portfolio as your circumstances change. In addition to external investments, consider investing in yourself. Building new skills, furthering your education, or even starting a side hustle can boost your income potential over time. Think of these investments as not just expenses, but as stepping stones to a brighter financial future, whether it's taking a course to advance your career or learning a new trade that could open up additional income streams. Investing in yourself often yields the highest returns. Now, I want to address the role of technology in managing your finances. We live in a digital age where apps and online tools can simplify almost every aspect of financial planning. From budgeting apps that automatically categorize your expenses to investment platforms that let you invest in fractional shares with minimal fees, technology can be a powerful ally. However, while these tools are incredibly useful, it's important to remain engaged and not let automation take the place of thoughtful decision making. Use these tools to gather data and insights, but always apply your own critical thinking when making financial decisions. Another significant point to consider is the balance between enjoying your money today and saving for tomorrow. Life is meant to be lived, and while it's important to plan for the future, it's equally vital to enjoy the present. The key is moderation. Allocate a portion of your income for experiences that enrich your life, be it travel, hobbies, or time with family, and balance that with your commitment to saving and investing. Financial freedom isn't just about accumulating wealth, it's about creating a life that aligns with your values and passions. As you continue on your financial journey, it's also important to build a support network. Surround yourself with people who share your commitment to financial growth and who can offer advice, support, and even accountability. Whether it's joining a local financial literacy group, participating in online forums, or simply having regular discussions with friends and family about money matters, these connections can be incredibly motivating. They provide a platform for sharing experiences, learning from others' mistakes, and celebrating successes together. I'd like to leave you with a few parting thoughts. First, remember that your financial journey is uniquely your own. There's no one-size-fits-all solution when it comes to money management, and what works for one person might not work for another. Be patient with yourself and allow room for mistakes. They're part of the learning process. Every financial setback is an opportunity to adjust your strategy and grow stronger in your understanding of money. Second, stay flexible and be ready to adapt. The economic landscape is always shifting, and your financial strategies should be dynamic enough to accommodate changes. Whether it's an unexpected expense, a shift in the job market, or a change in your personal goals, don't be afraid to revise your plan. Flexibility is key to long-term success in managing your finances. Lastly, always keep sight of your why. What is it that you're truly working toward? Is it the freedom to travel, the security of a comfortable retirement, or the ability to support causes you're passionate about? Keeping your end goals in mind will help you stay motivated through the ups and downs of your financial journey. Thank you so much for joining me today and taking the time to invest in your financial education. I hope you found these insights helpful and that they inspire you to take positive steps toward mastering your money. Remember, financial success isn't achieved overnight. It's built one smart decision at a time. If you enjoyed this video, please consider liking, subscribing, and sharing it with anyone who might benefit from a clear path to financial freedom. Leave your comments and questions below. I'd love to hear about your own experiences or any challenges you're facing on your financial journey. Until next time, stay focused, stay disciplined, and keep striving toward your financial goals. Another crucial factor in achieving financial success is understanding income diversification. Many people rely on a single income stream, usually from their job, but that can be risky. If anything happens to your primary source of income, such as a layoff, business downturn, or unexpected health issue, you could find yourself in financial trouble. That's why having multiple streams of income is so powerful. There are several ways to diversify your income. Passive income investments, investing in dividend-paying stocks, real estate, or bonds can generate consistent cash flow over time. The more passive income sources you build, the less you have to rely on a paycheck. Side hustles, freelancing, consulting, e-commerce, and digital products are all ways to generate extra income outside of your 9-to-5 job. Even a few hundred extra dollars a month can accelerate your financial growth. Business ventures, starting a small business, whether online or brick and mortar, can provide financial independence if done correctly. The internet has opened countless opportunities for entrepreneurs to launch profitable businesses with minimal startup costs. Royalties and licensing. If you create intellectual property like books, courses, music, or inventions, you can earn money repeatedly from a single effort. This is how many millionaires build sustainable wealth over time. It's important to not just make more money, but also know how to protect it. That brings us to financial risk management. Understanding and mitigating financial risks. Many people focus solely on how to make money, but how to protect and keep it is equally important. Let's go over some of the key ways to reduce financial risks so that you don't lose what you've worked so hard to build. Insurance protection. Having the right types of insurance is essential for protecting your assets. Health insurance, life insurance, disability insurance, and liability insurance can prevent unexpected events from wiping out your savings. If you're a homeowner, property insurance is non-negotiable. If you run a business, having business insurance can protect against lawsuits and losses. Legal protections and estate planning. Many people neglect estate planning, assuming it's only for the ultra-rich, but even if you have modest assets, you should have a will, a power of attorney, and a healthcare directive in place. These documents ensure that your money and assets are distributed according to your wishes and that your loved ones don't have to deal with unnecessary legal headaches. If you own rental properties or business, setting up an LLC or trust can protect your assets from legal liabilities. Market diversification. If all your investments are concentrated in one sector, one country, or one asset class, you could lose everything if that market collapses. A diversified investment portfolio helps minimize risks while still allowing for growth. Consider spreading your investments across stocks, bonds, real estate, international markets, and alternative assets like gold, cryptocurrency, or private equity. Emergency preparedness. Financial risks aren't just about investments. Life can throw unexpected curveballs. In addition to your emergency savings fund, having multiple income sources, a backup job plan, or access to credit lines can help you stay afloat during economic downturns or personal hardships. How to use credit to your advantage, not your downfall. Credit is often viewed as either a lifeline or a trap, depending on how it's used. Mismanaged credit can spiral into high-interest debt, but when used strategically, it can accelerate wealth building. Good debt versus bad debt. Good debt is used to purchase appreciating assets, such as real estate, education, or business investments. These types of debt can generate income or increase your earning potential. Bad debt includes high-interest consumer debt, such as credit cards, payday loans, and unnecessary financing on depreciating items like luxury cars. These do not contribute to wealth building. Building and leveraging a high credit score, a strong credit score, 750 plus, gives you access to lower interest rates, better loan terms, and more financial flexibility. To maintain a high score, pay your bills on time, Payment history makes up 35% of your credit score. Keep credit utilization low, ideally under 10% of your total credit limit. Avoid opening too many new accounts at once. Check your credit reports regularly to dispute errors. Strategic credit card usage. Use credit cards for rewards, cash back, and travel points, but always pay the full balance before the due date to avoid interest. Consider business credit cards if you run a side hustle or business. Many cards offer expense tracking benefits and higher cashback percentages for business-related purchases. If you need to finance a large purchase, use a 0% APR introductory offer instead of taking out a high-interest loan. Using credit wisely can help you scale your financial growth without falling into the trap of unnecessary debt. How inflation and economic trends affect your wealth. Inflation and economic cycles have a major impact on your finances, and understanding them can help you make better financial decisions. Inflation. Inflation decreases the purchasing power of your money over time, meaning the same dollar buys less in the future. This is why simply saving cash isn't enough. You need to invest so your money grows at a rate higher than inflation. Stocks, real estate, and commodities like gold tend to outpace inflation over the long term. Interest rates and borrowing costs. When interest rates rise, borrowing money becomes more expensive. This affects mortgages, credit cards, and business loans. When rates are low, it can be a great time to lock in a fixed mortgage or refinance high-interest debt to save money, recession-proofing. Your finances. Economic downturns happen regularly. The best way to prepare is by diversifying your income, keeping your expenses low, and maintaining an emergency fund. Recessions also present buying opportunities. Stocks and real estate often become undervalued, and those who have cash or financing available can acquire assets at a discount. The power of giving and financial legacy planning. One of the final stages of financial mastery is considering how your money can impact others and create a lasting legacy. Charitable giving and philanthropy. Many wealthy individuals set up donor-advised funds, DAFs, or charitable foundations to support causes they believe in while receiving tax benefits. Even if you're not ultra-rich, donating a portion of your income can be fulfilling and create positive change. Legacy wealth planning. Think about what kind of financial footprint you want to leave behind. Whether it's real estate, a business, or investment funds for future generations, legacy planning ensures that your hard work benefits your family and community long after you're gone. Teaching financial literacy. One of the most powerful things you can do is pass on financial knowledge to your children or younger generations. Teaching kids how to save, invest, and manage money early can set them up for long-term success and prevent financial mistakes that many adults wish they had avoided.